What's going on, y'all? Welcome to the latest edition of the Hashing It Out live stream. Today we are having a special edition with one of our analysts at Hashrate Index, Yaron Mellerud. Yaron, how you doing, man?
I'm doing great, Colin. How are you?
Pretty good, man. It's a beautiful day here in Tennessee. I know that you said it was raining up in your neck of the woods in Norway. Um, yeah, I hope settling into the winter months pretty easily there for you.
Yeah, especially today when we see the hash rate going down. That's always makes the day a bit lighter for me. So that's great.
Yeah, man. Nice to see that we're finally having some hash rate tapering off. Um, we've got like a 10% negative difficulty adjustment coming our way potentially if this stays. And we'll hopefully stay down for a little while. It makes sense though. There's kind of been a lag on miners shutting off as we kind of reach this hash price bear environment with hash price being at all-time lows. Uh, sorry, Aaron, really quickly. It looks like our screens are not showing up. Let me see if I can tinker with this. Oh, there they go. Okay, let's hope that they stay. Okay, and now they are not staying. Wonder what's up with that. Hey, there we go. Okay, I think that should do it. It looks like they're up now. Okay, cool. Sorry about that, guys. If you've been tuning in, apologize for not seeing our beautiful faces. Now you can see them. And today we are going to be talking about some Bitcoin mining stocks, particularly some of the reporting that we've seen from Q3 earnings reports, 10Q filings from some of these miners. Yaron's done a lot of really good work on kind of unpacking some of the more buried details of their debt obligations, their cash flows, and trying to kind of paint a picture of just how financially healthy some of these miners are, which ones are actually executing properly, and which ones might be kind of in trouble. I mean, as we've seen recently, Core Scientific, one of the biggest Bitcoin miners out there, the biggest in terms of hash rate capacity, is on the brink of going bankrupt. It looks like they got ahead of their skis there a little bit too much. And this a bankruptcy looming like that just kind of highlights how precarious this industry can be, and also how misleading press releases and news can be, right? Because going into 2022, Core Scientific seemed to be a kind of titan. They just kept deploying hash rate, exahash after exahash, kind of seemed like they were going to just be, a juggernaut. And it's part of the reason why they were able to deploy so much hash rate and kind of sprint out the gate is they had mountains of debt. And Yaron covered that in an article a month or so ago, kind of unpacking, just how much debt they're saddled or yoked by and how that's causing problems for their operations. So all of that being said, when we look into the filings for some of these miners, Yaron, we can kind of start piecing together the true financial story that we might not get from their press releases and things like that. Yeah.
Yeah. So the most important thing right now is the how much debt the miners have relative to equity, and also the nature of that debt. Because right now it's about survival, and the miners with the highest debt relative to equity are the ones who are the most likely to go bankrupt. And Core Scientific already gave us some warning signs in the beginning of the summer or after they published their Q2 report. At that time, they had a very, very high debt to equity ratio compared to most other miners. And yeah, that should really have given the industry some warning signs that if the Bitcoin price didn't increase, Core Scientific would be in a real danger. And that's exactly what played out, and they went bankrupt later. And many analysts have learned now the hard way, me included, that no Bitcoin mining companies or no crypto companies in general are too big to fail. Like Core Scientific, just because they had so much hash rate online and were like operationally a really good high quality company, and that doesn't mean that they can't fail due to having just too much debt and a weak balance sheet. So I started in the beginning of November by looking at the balance sheet strength of the different public miners, doing some comparison of that. Published an article which is called An Overview of the Debt Burdens of the Public Bitcoin Miners. And in this article, you can see the 10 miners with the highest debt to equity ratios and the 10 miners with the lowest debt to equity ratios. And as you can see, Core Scientific is the miner with the clearly the highest debt to equity ratio of 24, which means that they have 24 times as much debt as they have equity. And this is naturally due to their equity value has evaporated as they announced that they might go bankrupt. There are all other miners also with dangerously high levels of debt. The biggest, apart from Core Scientific, is Greenwich with 6.6 in debt to equity ratio, and then also Stronghold with 5.6. And the interesting things with Core Scientific, Stronghold, and Greenwich is that they have a lot of this equipment debt and machine collateralized debt, which is among the worst type of debt you can have
So
right now.
that's one of the things I kind of wanted to probe next. And for those of you watching, you can see we've got the debt to equity ratio chart that Yaron published with this article. And I wanted to kind of ask you, you know, if and you kind of hinted at it there, is there something in common with these miners' balance sheets? I mean, obviously, besides the fact that they have super high debt, right? But is there kind of like a common thread that ties all of them together that have put, these four that you highlight here, Core Scientific, Greenwich, Stronghold, and Argo, in kind of a dangerous debt to equity ratio position? And does it have anything to do with those equipment financing loans? Because I know that Greenwich has like an $80 million ASIC financing loan outstanding. And you mentioned that those loans are some of the worst loans, and I assume that's because they carry such a high interest rate. Sometimes as high as 20%. Would you say that some of these ASIC financing loans are kind of part of the problem here for what's kind of burdening these miners under these heavy debt loads?
Yeah, exactly. It's interesting to see that those four miners on the top there are also the ones with the most equipment financing. And like at least Argo, Stronghold, and Core Scientific have announced that they have big financial problems right now. So, and these are the ones with the highest equipment financings. And as you said, it's because the financing cost, the interest rate on this debt is so high, so it takes a massive drag on the cash flows each month. And when the Bitcoin price falls as it has now, then of course these miners barely has any cash flows. They barely make any cash flows even before the debt payments now. So accounting for the debt payments, they need to like their cash balances will be they need to use their remaining cash balances each month to pay down this debt, and they starting also now to run out of cash, which will definitely lead to capitulation. And yeah, as we know, this capitulation has already started, but I think it's far from finished.
Yeah, it seems like we're entering kind of another wave of it right now, right? Like we were just talking about how when we were getting on the live stream, I mean, hash rate has declined like 14% over the last 2 weeks or so, from its all-time high of 274 exahashes down to what is it at right now? Like 236 exahashes, or 235, something in that ballpark. Seems like waves of miners are shutting off at the current hash price. Anything above, I mean, 8 cents is at break even for an S19J Pro, and anything above that, you're basically mining underwater at this point. So I would agree with you. It seems like we're hitting another wave of liquidations, or sorry, another wave of capitulation. And we can kind of see that in some of these finances and in some of the trouble for some other miners too, that we haven't touched on yet. Like Iris, for instance, seems like they are in trouble of defaulting on a $103 million financing loan to NYDIG as well. But instead of being too doom and gloom, how about we look at some of the miners who seem to be actually managing their operations well? I've got the top 10 by lowest debt to equity ratios of the public miners in front of me. Any kind of takeaways here that you would highlight for some of these? I know that some of the ones with the lowest are guys like BitDigital and DigiHost, which people don't usually think of being, the most, how should we put it, the most, favorable operators. But we also have Hut 8, Cypher, and CleanSpark here with low debt to equity ratios.
Yeah, the main takeaway here is that there are a few Bitcoin miners who have taken on very, very high debt, taking on a lot of risk. And then there are actually most Bitcoin miners, they have kept their debt relatively low compared to equity. We see, for example, as you said, BitDigital, DigiHost, also Hut 8, Cypher, CleanSpark, Riot, they barely have any debt, and especially not any high interest debt like equipment financing or Bitcoin backed loans. So these miners right now, the ones with little debt, they have a massive advantage right now in that they don't need to pay to make these debt service payments, which means that they are actually able to spend their operating cash flows on other purposes, like expanding their operations during the bull market, and they will also not have to use their liquidity each month to pay for servicing the debt. So, and they can also take on more debt if they want now, because miners with high debt, they will not, no banks will give them any more loans. Like after Iris Energy is defaulting on this $100 million loan, no bank will give them new equipment financing or other loans. But for example, Riot, they could take on debt if they wanted, because they have a strong enough balance sheet to do so, which means that they have access to more financing right now when it's needed the most.
So for these miners that have lower debt to equity ratios, is a lot of that, is it kind of a mixture of just being good managers of their cash and their cash equivalents like BTC, or is part of it also equity fundraising? Is it a mix?
Yeah,
Is it kind of depends on the miner?
it's a good mix. Like for example, Hut 8 has been the miner which has diluted their shareholders the most this year. But that has been, like, many shareholders have not been that happy with that, but it has also led them to having a very, very strong balance sheet. Hut 8 could potentially they have kept it's the only Bitcoin miner except Marathon that has kept all their Bitcoin mined, never sold a single Bitcoin. And that's because they have raised equity. But it looks now like it's much more difficult to raise equity. So Hut 8 has taken on some Bitcoin loans just lately. We also saw Marathon do the same. So some of these companies are already now starting to take on some debt which they didn't have before, and that's not necessarily a bad thing. It's just like at any time there will be some financing options which are better than others, and that might also be that, especially now in the bear market.
Right. So you mentioned that Hut 8 is leveraging its Bitcoin stack, and I thought that it had closed out its positions for collateralized Bitcoin loans, but turns out I am wrong about that, and it's actually a good segue to kind of jump right into um, this article on Hut 8's Q3 report. So I don't know if you know off the top of your head. I assume it's in here. Do you know how much they locked up in terms of BTC?
No, I don't have it here.
Okay, no worries. Um, well, let's focus on some highlights from this report, and you kind of hit on it there. But it seems like Hut 8, as you show in this article, very low debt, high equity value, and a lot of Bitcoin. Like, what is it? Um, how many Bitcoin is it? It's like
8,687.
8,676. That's a lot. At the time of the writing, that's just south of $200 million worth of Bitcoin. They also have $33 million worth of cash. So yeah, I mean, kind of covering it by saying that, but I mean, any takeaways here?
Yeah, so this all this cash and Bitcoin on their balance sheets gives us a strength to expand now during the bear market, which is exactly what Bitcoin miners should strive to do. It's better to expand during the bear market than the bull market, as we know. So yeah, they definitely have the possibility to expand, and they announced recently that they are not operating. I think it was 0.8 exahashes with Validus
Right.
due to some disagreements in this power purchasing agreement. And they mentioned also in this announcement that they have the capital to pursue other strategic opportunities. So for me, that sounds like they are looking for another site to place their miners in. And as we know, there's a lot of sites now that from miners who have gotten bankrupt or hosting providers. So I wouldn't be surprised if we see Hut 8 buy some distressed mining sites in the coming weeks or months.
I wonder if they'll try to expand to the U.S. because like they've more or less, I think, or totally are just in Canada, right? Like
Yeah,
that's all of their like they've got places in Medicine Hat, in Alberta, and in, am I right in thinking Quebec? Like
yeah,
yeah, and it's been really interesting to see um, just how I mean, interesting as a bystander. If I was running one of these companies, I'd probably be tearing my hair out. But just how precarious the situation is for Canadian miners. Like, seems like they're always fighting this constant tug of war with Canadian regulators, local governments, and the federal government too, in terms of their right to be able to be power purchasers in all of these different regions, right?
yeah,
And when the great hash rate migration kicked off from China in the middle of 2021, I think a lot of people were expecting more hash rate to land in Canada than actually ended up landing there because, as my understanding from talking with like Jamie from Hut 8 and a few others, is that like incumbents in Canada have a pretty strong footing, it's a pretty strong foothold, but leasing new power to miners is something that is um, uh, the power companies basically are yoked by all of this regulation, and to actually get your foot in the door to gain new PPAs was like something like Hydro Quebec and other power providers in some of the more energy rich parts of the country. It can be quite difficult, and I'm just curious. I haven't looked too much into the Validus troubles that they've had, but to me, it just seems to be an extension of this constant push and pull with Canada, which is part of the reason why Bitfarms has been trying to expand out of the country, going to Argentina and building out some sites in the U.S. as well.
yeah. That's a good strategy of Bitfarms.
Yeah, to me, it seems smart to want to arbitrage different regulatory or just different jurisdictions, right? I think like China. I mean, granted, like China does not have the best property rights of modern nations and modern, industrialized first world nations. But that being said, I don't think that it's wise for any public miner or large scale miner to just put all, and even smaller miners to put all of their eggs into one basket, right? Like, as much as I, think that the U.S. is probably a good place for hash rate, even betting that property rights and things like that here will pan out and miners' favor is could lend itself to some danger down the road. Um,
Yeah, but there's also a lot of other things that could go wrong. Not only the government going against the operation, but if you have only one mining site, there could be some issues with the electricity provider, like exactly what we saw in Hut 8's case. Um, yeah, it's just a lot of things that could go wrong when you put all your eggs in one basket. And I think that's what's so interesting now that Hut 8 is heavily diversifying into high performance computing. So
mm-hmm. Yep.
yeah, like a 40% growth this year in the high performance computing revenues. And that's interesting because high performance computing is it's a more stable business than Bitcoin mining, but also it also has quite high margins. So it seems like Hut 8, uh, instead of diversifying into other countries, they're diversifying into just other business trends.
Yeah, for sure. And this is also especially relevant given the merge, right? Because I'm pretty sure that Hut 8 was a big ETH miner, and basically all of their GPUs have been redirected towards, whatever high performance computing needs are out there, like whether it be training, machine learning, or certain graphics generation and things like that. So,
Yeah, and Hut 8 actually acquired 5 data centers from a high performance computing company in January for $30 million. So
oh,
they
wow.
not really repurpose their own data centers to high performance computing. They actually purchase a high performance computing company, which just shows how serious they are into the entrance of this new segment.
For sure. And to your point, I think going forward, this is something that people have started talking about more and more. But like, mining is all about finding edges and efficiencies. And if you can find some sort of alternative revenue stream to bolster operations when we have times like this, where it's a hash price, ultra bear market, and you're basically only making like a few dollars per S19 at this point per day. Something like finding those edges and efficiencies and also alternative revenue streams for your business are going to be crucial for separating the wheat from the chaff going forward. Um, all right, cool. Well, with Hut 8 covered, let's go ahead and, since we started talking about them, let's jump into Bitfarms really quickly. Um, so, as I can kind of tell from this article, from my reading it, the takeaway is Bitfarms kind of has could find themselves in a dangerous position with some of these machine collateralized loans, and also the fact that they have now collateralized. Um, I think it was like the VAT, like what, 3/4 of their Bitcoin stack for a BTC collateralized loan. And if Bitcoin goes down to like 14,200, I think you say in this article, they're at risk of having to basically collateralize. They'll have to collateralize the rest of their holdings, and they won't have any more dry powder left for that loan.
Yeah, yeah. This is the like it's interesting to analyze the financial statements of like Core Scientific, but everyone knows that they are in so big trouble. So Bitfarms is really interesting because they're like kind of on the edge. They are just like Core Scientific. Bitfarms is a very very great operator, but they have I don't think they anticipated the bear market to be this bad. Like none of us did. So they have quite a lot of Bitcoin collateralized debts, and now they have collateralized or they have committed almost all this Bitcoin to this loan. And just like you said, if the Bitcoin price falls to 14,200, and their lender, which is Galaxy Digital, will start to liquidate this loan, which will be really, really terrible for for Bitfarms because they don't have that much cash either. So and Bitfarms is also cash flow negative each month because they have to pay this debt payment costs. So I think Bitfarms will have to raise more equity, but we know how difficult it is to raise equity right now. So it will be interesting to see. I think they will really struggle if the Bitcoin price doesn't go up.
Right, and to your point about raising equity, I think I don't know if you pointed this out in one of your articles or if it was pointed out in something else that I was reading on socials or in another article. But like Hut 8 announced like a $200 million at the market offering, which for those who don't know, that's like kind of like a revolving offering where you set a kind of ceiling for it and then you keep issuing shares until you either close the offering or hit the ceiling. And I think Hut 8 has only been able to sell like $2 million so far of that $200 million at the market offering, which is really crazy when you think about it. Is like they've only been able to raise 1% of the total seal. I mean, they don't want to issue all of that 200 million probably, but that just kind of gives you an idea of how difficult it is to fundraise using equity right now in the bear market.
Yeah, exactly. And that's also what like 1 month ago, Argo the share price fell like I think it was like 70% because they announced that they were not able to raise equity from a strategic investor which had already like agreed to purchase stock in the company. But this investor didn't want to do it at those terms. So then the stock declined like 70%. So it also shows that raising equity right now is extremely difficult. And I don't think Bitfarms will be able to. If Argo and Hut 8 weren't able to raise equity, then I don't think Bitfarms will be able to do it. But yeah, and the interesting thing about Bitfarms is that they are having quite high Bitcoin mining margins. They have kept their costs quite low during the bull market. They were not relentlessly expanding like some of their competitors. They still were keeping their costs low, and so they have access to quite cheaply priced electricity in Quebec and especially down in South America. But they have some problems in expanding into Argentina because of the Argentinian bureaucracy. They are it's difficult to import miners into Argentina.
Yeah, that's one thing about a lot of the Latin American countries is like they have really cheap power, but a lot of the officials, the customs officials, understand that and they understand why Bitcoin miners want to come there. And getting rigs in sometimes can be difficult without, how should we say, spicing the deal up a little bit for the customs officials without, being too overt about it. Um, it's again just another kind of example of going back to what we were saying earlier. It's good to try to expand and to try to arbitrage jurisdictions and have your miners all across the globe just in case. But obviously, each jurisdiction comes with its own red tape and its own cultural way of doing business too, which can be a huge component. So it's sometimes a lot easier said than done. It's like we're gonna go set up 100 megawatts in this country. It's like, well, have you really thought about how that's gonna work and how that's gonna pan out with all the things about that place that you don't know? And luckily for Bitfarms, they have a lot of Argentinians on their team. I believe one of the co-founders is Argentinian, so it's a little bit easier for them to get their foot in the door. But anyway, all things to consider when you're running a publicly traded Bitcoin miner that is facing, you know, tens to millions, $100 million worth of debt burdens. All right, Yarn, we're running out of time here. I like to keep these at 30 minutes, but so we'll kind of wrap up right now with this report on Riot. And kind of similar to Hut 8, as you point out here, Riot has a pretty solid balance sheet. It seems pretty liquid right now. and they have very low debt to equity ratio. As you can see here in this chart, for those tuning in to the actual feed, you know, um, obviously had more equity at the beginning of the year, equity value when stock prices were high, but even still right now, as of October 2022, only 154 million in debt and 854 million in equity value. So, any particular takeaways from this, Yaron, that you would like to highlight?
Yeah, yeah, you're completely correct. They're liquid and really strong balance sheets. And the interesting thing about Riot from from the Q3 report is how much they reduced their uptime of the mining to achieve lower energy costs. So Riot had an uptime of only 52% in July. And that was because it was a heat wave in Texas, so they reduced their electricity consumption in order to so that the energy grid can have more can take on that extra energy. It's part of some demand response programs. So that significantly reduced Riot's average energy price, but they also mine significantly less Bitcoin. So you can see I have a chart there that shows how much less Bitcoin Riot produced compared to how much they should have produced if they had 100% uptime. And in Q3, Riot produced 796 less Bitcoin than they would with 100% uptime. Of course, they reduced their power costs, but just know that this reduced uptime is actually really, really costly for Riot. But at the same time, it reduces their power costs, so it's worth it.
Yeah, and they receive power credits for the next month for that, right?
Yeah.
Like in July, I think in June they produced like 6 million in power credits. In July, they produced like 9 million. And if
Yeah.
I understand correctly, that was actually worth more than they would have got from mining the Bitcoin, the cash value of the Bitcoin.
Yeah. It was exactly. But we should also remember that Riot has, I think like 2.5 cents per kilowatt hour all in energy costs. But it's all in energy cost is based on them reducing their uptime. So during these summer months, Riot had like 50-60% uptime, a significantly reduced Bitcoin production. So I guess that over a year, Riot will have like on average a 90% uptime. And that's that 10% reduction in uptime is to achieve the power cost of 2.5 cents. It's like a mining operation should be running at least 90% of the time. So it's quite costly, for them to. They need to reduce their Bitcoin production significantly in order to reduce their power costs to a low level.
Anything else you want to add about Riot before we close out?
Yeah, I want to add also that Riot is expanding into, or they also have different business segments, just like Hut 8. But Riot is 100% committed to Bitcoin mining. They're not doing any high performance computing. Riot is doing hosting, and also they have an engineering business line. And both hosting and engineering business lines are growing quite consistently, and both have actually had positive margins in the Q3. And it's interesting that Riot's hosting margin was 7% in Q3, but if we look at some other hosting providers, we see that they have negative margins. So it's interesting that Riot is able to have positive hosting margins, and Riot has a fixed price power purchasing agreement. And that is very, very needed when they're going to be a hosting provider, because we have seen now with Compute North not hedging their power costs. That's that's not too good position to be in when you're a hosting provider.
Right, and same with Corsair. They were trying to push 10 cents per kilowatt hour onto their customers because they didn't have long-term power purchasing agreements in place, which to me is it's just kind of almost unbelievable. And Ethan tried to explain it to me that if you look at graphs from like 2015 on, there's a downtrend in the cost of power over the long term, and so the way that Ethan Vera, our COO, has kind of rationalized it is that in 2020 and 2021, a lot of these companies kind of just figured that that trend would continue, and so they thought, well, we can get actually a better power price potentially next year versus if we lock one in for however many years at this price. So to give them a little bit of grace, there's that angle, but I still find it kind of wild that so many of these hosts just failed to lock in long-term PPAs that would give them a hedge against the kind of energy inflation that we're seeing all around the world. And obviously in hindsight's everything. It makes it seem so obvious. But if we're operating under the lens of these guys, assuming that their power prices are actually going to decrease, it would have made sense to not lock those in. But that's fantasy versus reality, and the reality right now is that a lot of hosts are, either eating the spread and not charging their clients more, or they're losing clients because their clients are no longer profitable under the new power rates they're trying to push on them.
Yeah, I 100% agree. When you have like 20% margin, 10% margin on your power as a hosting provider, that margin is so small that I think it's a wise decision to hedge your power price, even if you believe it might decrease a little bit next year.
Yeah, for sure. 2022 has been just kind of one, depending on how you look at it, one amazing revelation or one disappointment after the other. And kind of no shortage of stuff to think about or write about, huh?
Yeah, it's been a good year to be an analyst.
Yes, sir.
Not,
Yes,
not
sir.
for my not for my bank account.
Oh man. Well, on that note, that concludes uh, everything that we had on the docket for today. Yaron, thanks so much for joining us and lending your insights on all the great research that you've been producing for Hashrate Index. Where can people find you so they can follow you and learn more about all of your delicious little insights that you deliver to people's feeds every week?
Yeah, thanks, Colin. You can find me at Twitter at Jay Mellerud. I know it's hard to find me at that. It's JMELLERUD. Good luck on finding me.
And if you just Google, if you go to hashrateindex.com/blog, you'll find Yaron's work there. And I believe your social tag is connected to your bio.
Yeah, it's a better way.
And so you can find his Twitter there, and then it'll also you can find him from Twitter using his name there as well. If you just want to Google or search through Twitter. And if you would like to follow Hashrate Index or Luxor for live stream content like this, or newsletter or blog posts, please follow us at Hashrate Index and at Luxor Tech Team. And to subscribe to our blog to get written analysis like this in your inbox weekly, please go to hashrateindex.com/blog to subscribe to our newsletter. And with that, that's all she wrote, y'all. So we will see you next week. Yaron, thanks again for joining us. I hope you have a good week.